Have you ever stopped to ask yourself why your credit card rate is so high? When you look at a traditional credit card, you're looking at 20, 25, 30, even 35 plus percent, which can be absolutely outrageous when it comes to repaying that credit card. But there's a reason and there is a logic why credit card rates are so high. Credit card interest rates might seem outrageous, but this is because of the liability of the lender. It is not really driven by corporate profits. It is not driven by greed. It is the risk of you as a borrower, as an individual. A lot of people do not view credit cards as a borrowing tool, but it is actually something that is completely unsecured and has a super high risk. When you look at auto loans, you don't pay your auto loans, they take your car. When you look at mortgages, when you look at home equity loans, you don't pay those products, they take your house. That is the big reason, guys. When you look at credit cards, the issuer can wreck your credit rating very, very fast as you continue to accumulate the balances. And also, it is very expensive if they have to sue you, going through a personal liability, meaning that they have nothing that is guaranteed that they are going to get money or product back if you cannot and do not have the ability to pay. Now, in addition, with credit cards, a lot of people do take credit cards to bankruptcy court, and it is the first thing that they usually eliminate within that court system. Or when it comes to a job loss, when it comes to the inability to pay, credit cards are always the first thing to go. You're going to pay your mortgage, you're going to pay your auto loan, you need a house, you need transportation. When it comes to credit cards, similar to student loans, a lot of people at some point just quit paying them. So, with the risk, what is the biggest way that you can really do this, guys? It is not racking up the credit card bills. We know the credit cards in the United States have exceeded over $1 trillion at this point with balances that we're carrying. Again, when you're looking at 24% being the national average for credit card rates, $1 trillion on those credit cards, it is just absolutely crazy. So for consumers, high credit cards, loans, and high credit card balances are really what is the driving force of spending in the nation. We've lived outside of our means, and it's time to kind of reel it back a little bit. And of course, you don't want to pay the interest on there. Let's take a look at a couple alternatives, guys. Number one being the unsecured loan. So this is actually a typical unsecured loan where you might have an unsecured, which is essentially your credit card, but unsecured loans are a set rate, set term, meaning there's going to be a point where the debt is going to be paid off, which is going to be the big focus, guys. Now, with both of these scenarios, there are no collateral behind it. However, there is going to be a point where the loan is going to be paid off. So for instance, if you're carrying $10,000 on a credit card, and let's say theoretically your rate is 24%, the minimum payment on there is going to be pretty low. I would say $150, $200 on that balance. However, with the revolving availability, when you look at your statement making the minimum payment, you'll notice most of them say it's going to take 15, 18, 20 years to pay off that balance if you're making the minimum payment. And that is because of that higher interest rate. Now you take that same $10,000, you move it over to a credit union or financial institution like a bank that offers unsecured lending. You get a rate currently about 9%, maybe 10% depending on credit. So literally you're going from a 24% to a 10%, even let's say 12% if you're cutting your rate in 50%. Not only that is when you're looking at the loan, it is for a set term. So if you do it for 60 months at let's say 12%, boom, in those 60 months or less, depending on how you carry it, that debt is paid off and eliminated. Now, the caveat to this, guys, or the things that most people do miss within this point is having the ability to not rack up the credit card debt again. This is where it comes to the budgeting. You know, I was going to talk about it because I do in every single video. When it comes to that budgeting aspect, you cannot be spending more than you make. That is really ground zero, guys. If you're making $3,000 a month, you're spending $3,500. That is going to catch up with you. That extra $500 is going to be dropped onto credit cards, meaning that the balances month after month after month, you're going to be gaining $500 every single month. Meaning again, in a couple months, you're going to have a few $1,000s in there. Even if you do the consolidation to really free up a little bit of cash, possibly get a lower rate as well as get a lower balance. But again, you have to make sure with those unsecured loans that you do pay them and pay them on time. If your credit score is damaged, if you have a lower credit score, chances are it's going to be significantly higher. Now, one of the things, credit card defaults, like I was saying earlier, are huge defaults, which is the reason for the rise. When you look at historically, we've seen 2009, 2010, they were about 3 or 4%. It spiked at about 10%, and we are starting to see the exact same thing, guys, as we enter the student loan repayment, which is starting in October, coupled with the amount of credit card debt that people are carrying at the interest rate that they're carrying. Chances are that delinquencies, charge-offs, bankruptcies are only going to increase in the future. So, also with the credit cards, guys, you have to be careful of the variable rate. Now, majority of credit cards are variable. However, you can find fixed rates out there. Again, credit cards usually offer a fixed rate credit card, which means that it is going to be fixed regardless of the balance that is on there. And it is not an adjustable rate. It is not something that is going to change. Since currently we are in a high rate environment, we have actually seen credit cards go from 18% to 20 plus to 25 plus, again, depending on the market conditions. Now, with credit cards as well, they are very, very competitive. If you've ever checked your mailbox and got a ton of flyers or a ton of kind of junk mail that is credit card offers giving you 300, 500, 1,000. I even got one that said a $2,000 offer to open a credit card with a balance transfer, as well as putting money into savings. It's insane how kind of high they have gotten with these. Now, a lot of these are also rewards cards. When you think of it fundamentally, guys, reward cards are only good and only effective in one situation only. That is if the borrower does not carry a monthly balance and you are paying off the card in full every single month. That is the only reason, by far, number one, that you should ever have a rewards card. If we're going back to the methodology with Dave Ramsey, credit cards will not get you anywhere. He said, you know what? Never made a millionaire was a credit card. But for a majority of us, credit cards do have a lot of great benefits. If you're paying it off every single month, it doesn't matter what rate you're offering. It matters more of what rewards you're getting from that card versus what they're charging you. Again, if you're really paying it off every single month. Because what happens is if you are not paying that off every single month, you're paying for the rewards. So you're paying for your rewards program with the interest that they're charging on the payments that you're making. So even on a rewards card, if you're carrying a couple $1,000s on that rewards card, the chances are it pales in comparison to the rewards that the card is actually offering you. The 2% cash back, the 3%, the 5% in groceries. It is really pale in comparison when you look at your statement and you look at the interest that they're charging in comparison to the rewards that you're receiving from the card. 95% of the time, it is not worth it by any means to carry that balance. Now, again, a couple strategies to lower that APR, guys. Moving it over to an unsecured loan, looking at the home equity products, possibly doing cash out refinances on auto loans, and managing the debt. Big thing again, really, really important is managing not only the money coming in, but also where the bills are going out. It's super interesting to see that a lot of people want to make money. They want more income, the side hustle, doing all of these things. However, on the flip side, the debt elimination and the debt repayment is not really the big focus because it is more about making money than it is about saving and retaining it, building wealth through investing. So guys, that'll do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.